Welcome to Advanced Trading ATI Agency. Brady Huck here. I'm a futures options broker and LRP insurance agent with ATI Advanced Trading. Thanks for joining me today. If you're here, you're wondering what is LRP? This is kind of a 101 crash course on what is LRP and how can we help you use it. We can help you, one, with LRP, teach you what it is, and then two, take it to the next level by combining it with options, CME options, your hedge account. But let's first dive in to what is LRP. We're going to be looking at it specifically from a feeder cattle, cow calf, backgrounder, stalker type outlook. It's available in, cattle. It's available in fed cattle, fat cattle, finished cattle, also available in hogs as well. But we're going to just kind of simply look at it from a cattle perspective, feeder cattle. So what is LRP? Stands for Livestock Risk Protection. It's a subsidized floor price. It settles to the CME feeder cattle index. That's the same index that futures and options settle to. We'll talk about that here in a little bit. One of the great things about it, it's coverage on a per head basis. Some of the downfalls of trading options or futures is it's a 50,000 pound contract, 60 head of 800-pound feeder steers. And when not all producers fit in that bucket, some people, maybe it's not perfect. Maybe it's a little too small for some, and they're in between one or two contracts, or they don't have quite enough head to cover with one full contract. LRP is on a per head basis, so it maybe is a little more customizable to the smaller operator or somebody with 75, 80, 100 head that doesn't falls between the 60 and 120 that a regular feeder cattle futures or options position might use. Subsidized put floor. LRP adoption, it really increased in 2020. They made some changes to the program. They made some changes to the subsidy. I think it went from a flat rate 13% subsidy to a 35 to 55% subsidy. Most of the subsidies that I deal with and the quotes that I deal with are in that 35, 40% subsidy, which is those top tier coverages. You drop down to the bottom tier coverages, and they're more in that 50% subsidy, but it's less total dollars. And mathematically, often it makes sense to kind of pay up and get that better coverage to stay tight with where the market's at. But LRP, it's a federally subsidized crop insurance program designed to protect livestock producers against significant declines in market prices for their animals like cattle, swine, lambs, essentially providing a floor price below which they can receive a payout if the market price falls during their chosen coverage period. It's not mortality insurance. It's not, it doesn't protect against mortality, it protects against price coverage. So let's dive in. We'll talk about the CME feeder cattle index. Again, the LRP, the feeder cattle coverage protects you, and essentially it protects that feeder cattle index. It doesn't protect the value of the cattle that you're selling. You may sell above or below the feeder cattle index depending on your region, the type of cattle you are, the weight of your cattle. But what you're buying is a policy that hedges and protects you against the CME's feeder cattle index. And the index is a 7-day weighted average. It's total dollars sold during that 7-day period divided by the total pounds sold. And it's every feeder steer sold in that 7-day period has the same impact on that final price. It's 700 to 899 pound feeders reported from live auctions. There's mandatory price reporting on those public auctions, some internet sales, direct trades, publicly reported cattle in these 12 states here. Total dollars sold divided by that total pounds sold gets you that feeder cattle index. Moves every day. It's posted every day. And that's what you're protecting when you buy a feeder cattle LRP coverage level. Fed cattle LRP, it's a little less popular, most likely because fed cattle, just retained ownership is less popular. A lot of people raise cow calves, but as you progress down that chain, there's less people participating in that ownership as after weaning, running stockers to yearlings, and then ultimately feeding them out the last step before they go to the packer. There's just declining number of people there. So it's naturally a less popular product, but it settles to the 5 area cash steer, choice steer price that's printed, also mandatory price of printing for that week of settlement. But we can talk fed cattle specifically. Give me a call if you're interested in fed cattle. It's a tool we also use, but we're talking specifically the feeder cattle LRP coverage. There's different classifications. Primarily classifications that we use are the unborn steer and heifers, steer weight ones, heifer weight ones, steer weight twos, heifer weight twos. They have a price adjustment factor, which can kind of make things a little confusing, but it's just how the coverage is quoted. And ultimately, I like to present it as unborn steers and heifers, you're protecting this price, and we got to calculate that back to what index equivalent price is that actually protecting, so that what dictates whether I get paid or not, whether I get a bill or a check on this policy. But unborn steers and heifers, that is 100 to 599 pounds. It has a price adjustment factor of 105%. So if you're at a 260 level, which is kind of where we are today, you'll see quotes, top tier quotes will be in that mid 270s, 273. But at the end of the day, it's kind of you're going to divide by that same factor and compare that to the index to dictate whether you get a payment or not. Overly confusing. My job's to simplify and help you understand what the heck it is you're protecting. Steer weight ones are 110% of the index. That once they hit the ground, we know if they're a steer or a heifer. Before they hit the ground, this unborn, that's what you use to protect your cow calf guy for that next calf crop. Steer weight ones are to protect the calves that you're going to probably sell at weaning or shortly after weaning. Those are animals on the ground. If they're steers or heifers, let's get them close, and we'll have that appropriate coverage for that. But the steer weight ones are 110% of the index, and the heifer weight ones are straightforward. They're going to protect 100% the index level. No math needed on that. 100 to 599 pounds. If you go over that, if your calves at market time during that policy coverage day are bigger than that, no penalty, nothing. You're just maybe undercovered for what the total pounds you have to market it. They outperformed. Where you get dinged is if you buy that next level, steer weight twos, heifer weight twos, and if you have an average marketable calf that's 550 pounds instead of the minimum, that's 600 to 1,000. If you fall below that, that's when they'll start reducing head count on that. So important thing to understand, which class should I be in? We can talk through that on a one-on-one basis to make sure you're in the right product. But the steer weight twos protect 600 to 1,000 pounds. Heifer weight twos 600 to 1,000 pounds. Again, on a per head basis, you can buy coverage on one heifer. You can buy two heifers, and you can pick 605, 603, 999 pounds. If your animals are 800 at the end of the day, but you bought 999 pounds of coverage, you're going to get paid on that 999 pounds of coverage number. You're paying, you're going to pay per hundredweight on that coverage, but it's, a lot of pounds for that animal too. So try to match that up, I guess, to the appropriate animal, but you can adjust that and tweak that to your needs. The end dates also, the time frame, they go in, 17 week, 21 week, 26 week. We can go out to 52 weeks for your coverage. If you want to go beyond that, you might be better suited off on an option strategy or something on the board to go out further than that. They're offered out to 52 weeks. And they'll settle to the index on that date that gets when you choose to buy the coverage. So claims, they're billed in arrears, meaning at the end of the policy, you either get a bill or a check when that coverage comes up. This is one of the changes they made in 2020, which is huge in today's market where you have higher interest rates and the cost of money, that operating capital can be a little thin at times. Not having to put that money up front and then just getting a bill or a check settlement on the end, that's a huge piece of the puzzle here, and one of the things that makes LRP very attractive. They did make some changes recently here where you have to show proof of ownership. One bad apple spoils the whole bunch, so we got to play by some rules. It's very simple way to show proof of ownership. Purchased, if you bought some stockers that you're running on wheat, a ticket that you purchased them. A sales ticket if you sold them at market, weaning records, calving records, even third-party letters the letters of, hey, I'm a vet, consulting vet for this operation, and I certify they have, X number of head of cattle that I've seen in person. Those work for proof of ownership claims. So trying to think of other little tidbits that come up. The subsidy, since it's a federal government program, you need to have a conservation compliance form completed with the FSA. It's a very common form. If you've done any type of loan with the FSA or paperwork type stuff, you've probably completed this form. AD 1026 form is the number of the form. If you've done any government type loan or any paperwork payment type stuff before, you've probably got it on file, but that is a requirement if you're going to receive the subsidy. You can still have the product without the subsidy, but most people, if they don't have that 1026 form done, they go ahead and complete that. But that is up to you. Common misconceptions with LRP is, one, you don't have to sell the animals at the end date. You could have coverage that ends tomorrow, and I could click retain ownership and say, you know what, I kept them. I decided not to sell them. I don't have to sell them. Okay. The second thing is, it's not a guarantee on the price of animals you sell. If you go buy the big steer weight twos and protect 260 on that and check that I'm protecting 1,000-pound animal, you're not selling 1,000-pound steer for 260. That's some people may misunderstand what that means. On the flip side, a 3 weight at at 110% adjustment factor at 286, well, it's just against the index. You're not selling a 3 weight for 286 a pound when the market today is more, in that 4, 5, 6, $4 or $5 a pound, maybe even $6 a pound. You may look at that number and say, whoa, that's terrible coverage. It's against the index. And it's important to understand that, always tying that back of, I'm protecting against the feeder cattle index. Those are some common misconceptions that we run into with LRP. Again, if you have, want to visit one-on-one with this, invite you to call me, talk to me, and we'll answer any questions you have to get you comfortable with the product and see if it's a fit for your operation. Phase 2 of this is enhancing LRP with options. And this is where you can really unlock the power of managing volatility in a moving market. So first step is to get control and have, a level of coverage, and before the price falls apart. That's the goal, right? And then if the price continues to get better, one example we could talk about is, let's say you buy LRP today and say it's 260 and the market goes higher, rallies higher. If there's an opportunity to raise your floor to 270, is there, that's $10 higher. Can we do that on the options piece to pay $2.50 to raise your floor $10? If that opportunity presents itself, we think it's a good idea, and it's a way you can improve your coverage and ratchet it up as the market rallies and continues to get better. Just at the end of the day, protecting more dollars as the market gets better, because we know those rallies don't last forever and they can sell off very quickly at any point in time. Vice versa, the opposite side of enhancing your LRP with options is you buy 260, that same level, for example, and the market sells off 10, 20, 30, maybe more bucks after you buy it. You've lost some value on the cattle, the cash cattle. These things can sell off and then they bounce back up, but your LRP at that point in time there might be some things we can do to go protect the equity in that LRP, because it looks like it's going to pay out. But if that market rallies, yeah, you're gaining on the cash animal. That's a good thing, but you're offsetting that potential premium. And maybe we can go protect that, where if we rally back up to that 260 level, instead of selling your animals at 260 and paying the LRP premium, you'll still pay the LRP premium, but maybe your board position offset that premium because you bought a position that gained value as that market rallied. And trying to use positions, one, that have defined risk, and two, don't require margin. A lot of producers aren't comfortable with margin, and there's things you can do like this that aren't marginable positions, that just, hey, this is a defined risk position that costs me a couple bucks. I can spend $2 and protect 10. The math on it makes sense. I like doing that. It's your choice to make, but we can walk you through the options and choices you have when they present the opportunity to do so. So that's kind of in a nutshell some, basics on LRP, what is LRP for cattle, feeder cattle specifically? And then what are some things you can do to manage the equity in LRP as markets move and things change? If you're interested in LRP, I invite you to give me a call today. Shoot me a text message. I'm typing my number in here right now as fast as I can, for you to be able to call or text and get a hold of us. Let us know. We can get you set up for automatic quotes that are custom to your specific situation, and just get you some more information or answer any questions you might have on LRP that I didn't answer here in this video. But appreciate your time. If you have any questions, give us a holler. We'll let you get back at it. Thanks. See ya.